What's up, everybody? We're going to dive into this today. Lots of builder incentives. We're going to talk about how builders are making homes look cheaper, and I'm super pumped to chat with you. If you do have comments or questions, please reach out. You can always reach out to me at the number on the screen. But let's get into it. A buyer may currently be able to purchase a brand new home with roughly $500 out of pocket. Think about that. A down payment assistance program may cover the required down payment. Builder and lender concessions may cover eligible closing costs. And when the entire package lines up, a qualified buyer could potentially come to the closing table with only a few $100s. If you are interested in hearing more about that, just comment below or send me a DM on whatever platform you're on, and we can dive in. Now, put yourself in the shoes of a Denver homeowner trying to sell a resale home nearby a new construction. This is something that we need to discuss. You may have a beautiful house, you may have updated the kitchen, you may have priced it correctly based on the recent comparable sales, but the builder down the road is not simply selling a house. The builder may be offering down payment assistance, thousands of dollars in closing cost credits, a subsidized mortgage rate, a warranty, and a completed home that needs very little immediate work. That means Denver sellers are no longer competing only against the house down the street. They are competing against companies that can manufacture a lower monthly payment and dramatically reduce the buyer's cash needed at closing. Tonight, we're going to break down how these builder incentives actually work, when they represent a legitimate opportunity, what buyers need to watch carefully, and how resale homeowners can still compete without blindly slashing their prices. And stay with me because I'm going to show you why a more expensive new home can sometimes have a lower payment than a discounted resale, and why that still does not automatically make it a better financial decision. We're going to dive into all of that, but obviously comment below and let's have a conversation if a new home sounds okay to you. What's up, everybody? I am Jeremy Kane with eXp Realty. Welcome back to Why Invest Wednesday, where we cut through the Denver real estate noise and talk about what is actually affecting buyers, sellers, homeowners, and investors throughout the Denver metro and northern Colorado area. If you're watching live, comment the city, neighborhood, or community where you're considering buying or selling. It could be Parker, Aurora, Thornton, Castle Rock, Brighton, Erie, Commerce City, Arvada, Littleton, Fort Collins, Loveland, wherever you are looking. Comment your area, and I can send you a comparison of resale homes to builder options currently competing for buyers in that market. Because the answer is not automatically buy new, and it's not automatically buy resale. We need to compare the full financial package and the actual lifestyle value. So let's go down this road. Builders control more pieces of the transaction than an ordinary homeowner. A resale seller typically controls the asking price, the condition of the property, the amount of seller concessions offered or negotiated, negotiation around repairs and possession. A large builder may control the base price, lot premiums, upgrade pricing, closing cost credits, down payment assistance, mortgage rate buydowns, inventory release schedules, completion deadlines, affiliated lender incentives. That is a ton more than just that price and just the negotiating power. So if you're interested in learning more, let's roll. The ordinary homeowner may be able to offer a buyer $10,000 or $15,000, sometimes even up to $30,000, depending on the loan type, and closing cost assistance. A builder may be able to use tens of thousands of dollars behind the scenes to adjust the buyer's financing package. That is a real advantage. The builder does not necessarily need to advertise a huge price reduction if it can create a payment that feels hundreds of dollars lower every single month. Builders are also managing inventory. They have completed homes, future phase, quarterly sales goals, financing costs, and construction schedules. They are not emotionally attached to what the neighbor's house sold for 6 months ago. They need to move inventory. And when affordability becomes the biggest obstacle, builders start solving for affordability. Comment your area below. I will look at what builders are offering nearby and compare that against resale inventory buyers are seeing in the same general price range. We can go look at both. That comparison needs to include more than just the list price. It should include the rate, the concessions, taxes, HOA, Metro District costs, upgrades, and actual estimated cash to close. So, Lennar Homes right now, Lennar Mortgage offers down payment assistance programs that may be paired with eligible builder and lender incentives. One structure provides 3.5% assistance alongside an FHA first mortgage. The assistance is generally structured as a forgivable second mortgage, zero interest, no monthly payment on the on the loan, not the mortgage, potential forgiveness after the required period of qualifying payments. It should not automatically be called free money or an immediate grant. The exact cash required varies by home, purchase price, buyer qualification, credit, rate, taxes and insurance, prepaid expenses, available builder promotions, and earnest money already deposited. Let's talk about the $500 example because this will get attention and it should. Getting into a home for $500 with a lower interest rate than you could get from the market should be appealing. If you are in the market to buy a home, you should be looking at new builds if there's a new build project in your area. But that doesn't mean that you should automatically buy it. A qualified buyer on a select Lennar property may be able to combine down payment assistance with builder and lender credits so that the remaining cash required at closing is roughly $500. But I want to be precise here. This is not Lennar saying that every person can buy every home for $500. The buyer has to qualify, the home has to qualify, the available incentives have to cover the allowable expenses. The taxes, insurance, prepaid interest, loan terms, and closing costs all affect that final number. The down payment assistance may also be structured as a forgivable second lien rather than an immediate grant. That means the buyer needs to understand what happens if they sell, refinance, stop making qualified payments, or otherwise fail to meet forgiveness requirements. So yes, the opportunity can be real, but the headline is not the complete financial explanation. Low cash to close can solve an access problem. It does not automatically solve an affordability problem, and it does not create an emergency fund after closing. You could qualify to close with $500 and still need money for moving, window coverings, landscaping, a fence, appliances, furniture, insurance deductibles, and normal surprises that come along with owning a home. Houses have a magical ability to break the moment your savings account gets comfortable. So we still need a full ownership plan. So let's go into a couple scenarios. Scenario one, a resale in the market. Purchase price $550,000, loan $440,000, rate approximately 6.55%, principal and interest approximately $27.96 per month. Now, these are not quoted rates, they're just an example. Scenario two is a resale seller reduces price by 3%. New purchase price is $533,500. Loan is approximately $426,800. Same market rate. Principal and interest approximately $27.12 per month. Scenario three, builder offers a qualified 4.50 fixed rate promotion. Again, we're speaking in hypotheticals here. Purchase price is $550,000, $440,000 in a loan, 4.5% in the rate. Principal and interest is approximately $2,229 per month. Look at the difference. The resale seller cut the price by more than $16,000, and the buyer saved roughly $84 per month in principal and interest. The builder kept the price higher, but subsidized the mortgage rate, and the buyer's principal and interest payment fell by more than $500 per month. That is why a resale seller cannot look only at the neighboring sale prices. The buyer may be comparing your $533,500 house against a $550,000 house that a new build that carries a dramatically lower monthly payment. Buyers live in monthly payment. That is the biggest thing. We've talked about this on this channel, on my socials. If you haven't and you're interested in that, head over to my YouTube channel, Mile High Market Mastery, and you can check that out. Sellers are often emotionally anchored to the purchase price. And right now, the builder understands that difference better than many resale sellers do. Those examples exclude taxes, homeowners insurance, mortgage insurance, HOA dues, metro district charges, and other ownership expenses. We're talking principal and interest here. The builder rate may also require specific credit score, down payment, affiliated lender, contract date, closing deadline, or selected inventory home. We are comparing the structure, not promising a particular rate to every buyer. Now, before watching this runs into the nearest model home and signs wherever, before everybody starts watching this and runs to the nearest model home and signs wherever is placed in front of them, we need to discuss the other side. A lower advertised payment does not automatically mean a lower total cost of ownership. We have a permanent rate versus a temporary rate. And this is sometimes all the builders are different. So this is an important factor. Permanent fixed rate buy down or a temporary 2.21 or 3.21 buy down. Permanent fixed rate is a rate that will be available to you for the entire part of the loan, 30 years, 15 years, whatever that looks, as long as it's a fixed rate. A temporary 2.1 or 3.21 buy down is lowering the interest rate in a 2.1 buy down by 2% the first year, and then it goes up 1% the next year, and then for the entirety it goes to whatever that rate, initial rate was. Or 3.21 buy down, it's just adding another year to it. So headline rate requiring excellent credit and a large down payment are what we're talking about here. So if you're watching TikTok or you're watching Instagram and you see, interest rates are at 7 or 6 or 4, right? That is an advertisement of a rate that shouldn't be there, because it ultimately depends on your specific situation. And if you are looking to buy a home in the near future, let's have a conversation. I can connect you with lenders that can explain all of this to you. And even if you do go over to the builder side, the lender won't hunt you down, right? So we need to take this from an educational platform and understand exactly what it means to you, what's being offered, and so on. But big thing here, a 3.99% interest rate for the first year is not the same financial product as a 3.99% fixed rate for 30 years. So really here, when you start hearing 3.21 or 2.1 or whatever you're hearing, 1.0, whatever it is, you need to understand that that means that your interest rate will eventually be what the market rate is. The advertisement may feature the first year payment in letters large enough to see from Wyoming and place the permanent payment in the fine print. Read the complete loan estimate, understand if it's temporary or permanent. That goes across the board for all builders, all resales, everything. You have to understand what that payment is going to do based on the interest rate that's tied to that loan. Many new home communities use metropolitan districts to fund infrastructure. These districts may levy additional property taxes or fees. Sometimes they'll include the HOA as well, just under the metro district. So you just have really high taxes and it's not showing up as property tax plus homeowners insurance. Some are in a metro district plus an HOA, and you have higher taxes and an HOA payment. New construction tax estimates may initially be based on vacant land or incomplete valuation. That is something that you need to ask your real estate agent. And this is why real estate agents are important when you're going in to talk to a builder, is because we can ask these questions and we can dive into that. The complete tax burden may not appear in the escrow payment immediately if the lender is just trying to push you through. Maybe you're tight on DTI. So, they're going to use that. And then all of a sudden you're going to get a tax bill that all of a sudden is for a beautiful new home and a house built on a piece of land that you've been saving up in your monthly payment for a piece of dirt. And so that's something you have to focus on. The builder may lower your mortgage payment by $400, while the metro district taxes, HOA, and community fees quietly add part of that payment or more than that payment back. That does not make the community bad. It means we need to calculate the real number. And most builders that I've seen lately are going off of, the presumptive tax of what it's like after. But if you see a oddly low number, in your tax escrows, when you're signing all those papers, that's where you need to ask that question. Probably before in the loan estimate and those kind of things is where you need to really look out for it. So let's talk about costs outside the contract process. You have lot premiums. Sometimes those are thrown in as incentives. Sometimes they're vastly discounted in the larger builders. Sometimes they're not. The upgrade package. How much are you putting towards, putting flooring in a house or those kind of things? Some builders offer a one-shot prompt. Here's what you get. We have three design options and you get everything else. Everything else is chosen for you. Some builders literally have you pick everything out as you go through this build process. Landscaping is always, a hit or miss. Sometimes they throw it in as an incentive. Sometimes they just do the front yard. Sometimes they irrigate the front yard, not the backyard. But all of these things are something that comes up. A fence. Some places will require you to have a fence and your backyard landscaped within 6 months. You need to know that because that is absolutely part of what's going on, right? Your window coverings. How many windows do we see in these new builds? 30, 40, 50 windows that have absolutely nothing on them. And I've seen it where people didn't, budget for this. And I walk in 4 years later and they still have the cheapest paper blinds on the windows as they can because life got busy. That's not a problem that, that's not a, dig on those buyers that's happened from, but it's just an idea of how they went into it. Did they look for those costs? Were they aware of that? Did their agent negotiate some of that in? That's all part of the process working with a builder. Refrigerators, washer and dryers, all of this stuff is stuff that comes up. And when you're looking at the beautiful new countertops and the flooring and all of that, sometimes you're like, oh, there's no refrigerator there, right? And sometimes that's not till later on in the process, especially if you're not going in with somebody who's having you understand the entire process and understanding what comes with the house and what doesn't. Because obviously those appliances aren't showing up during construction, we hope, because if they do, they're going to be broken by the time you move in. And then all of a sudden we're at closing day, everybody's excited, you're looking through, you're making sure they fixed all the paint chips and everything, and you have a big hole where your refrigerator goes or your washer and dryer that you just sold with your last house. Basement finishes are some things that, come in. Sometimes in ranches that have basements, they throw that in, or sometimes they, will offer it as an incentive or a upgrade, sometimes an incentive. Deck or patio, actually having access to your backyard without that, little 5x5 concrete step. Community tech fees are also coming into play. HOA, metro districts, and commute expenses. A resale home may appear more expensive until you realize it already has the fence, the trees, the blinds or curtains, finished basement, backyard, appliances, and deck. And they may be old and they may break after you buy it. A price is not always a finished home price. It's a lot more that goes into it. And moving is expensive. Transitioning usually from a lower payment in our current market to a higher payment. And then all of a sudden you have all of these added expenses that can be big or small, but will add up over time. Let's make this practical. Comment the area where you are looking or where you would like to live, and I will compare the nearby builder communities against current resale options and show you what the real difference looks like. I'll even take you out to see those if you're interested in comparing side by side. Not, and notice I didn't say there, only if you're ready to buy, whatever. Let's go look at communities. I can shoot content. We can hang out. We can really get an idea of what's going on. Not just new versus used, shiny versus not shiny, granite versus slightly different granite. We will compare price, financing, cash to close, estimated monthly payment, property taxes, metro districts, HOA, included features, location, commute, resale competition, and likely maintenance. Comment the city or neighborhood, and I will help you build that side-by-side comparison right now. So let's go into future resale risk. Okay, a buyer purchasing in an active new construction community may later sell while the builder is still building. That homeowner may compete against a never occupied home, a newer phase, current finishes, model home marketing, builder financing incentives, closing cost assistance, down payment assistance, new home warranty coverage. This is the part buyers often overlook. The incentive that helps you purchase the home today may become the incentive you have to compete against when you sell it. I've had, longtime clients that lived in a new build and then they're like, dang, we want to move 18 months later, 2 years later, 1 year later. And if that construction process is still going on, it certainly makes it a lot harder because even a gently used home against a brand new something shiny home has a lot of perks. Then you throw on the builder incentives, and yes, they may be selling the home for $50,000 more than you bought it for. For now, our current market's pretty flat, so this is a likely scenario. And I've had one up in Loveland actually, where they bought the home from the builder. It was complete, done, ready to go. The builder was still building, and in that community, luckily, those prices rose a little bit, but we pretty much had to sell at a break even point, because they could walk down the street and get a brand new house with a little bit different setup for a much lower interest rate because of what the builder was offering. We ended up being able to do that because we were able to say, okay, we're going to price it here, but we can get an appraisal up here because of those incentives. So we had to compete and be aware of those incentives so that we had the opportunity to find the right buyer. Let's say you buy during phase 2 of a community. 3 years later, your life changes and you need to move. The builder may still be selling phase 4. You now have to convince a buyer to purchase your 3-year-old home while the builder is offering a never occupied version with a lower mortgage rate and closing cost assistance. That does not mean you should never buy early in a new community. It means the home needs something that protects its position. What are those things? A superior lot, finished landscaping, a completed basement, better views, more desirable orientation, a larger yard, upgrades the builder no longer offers, a price that reflects the competition, a realistic expected holding period is ideal. I would say if you're going into a new build community, it needs to probably be a 5-year plan for you to maximize your return on that investment. Do not purchase a new build assuming the builder will stop being your competitor the moment you receive the keys. Builders have a financing advantage. They do not automatically have the better house, better lot, better neighborhood, or better long-term value. What are some resale advantages? Established neighborhoods, mature trees and landscaping, more central location, larger lot, existing fence and outdoor spaces, finished basements, including appliances and window coverings, known tax history, no metro districts in many established areas, shorter commute, immediate occupancy, fewer years of living in a construction zone, more opportunity to negotiate after the inspection, greater clarity about how the neighborhood functions. A big one in Colorado is concrete. There's 2 types of concrete in Colorado, they say. The cracked concrete that's moved a ton and settled, and the concrete that will move and settle and crack. So you have to be aware. A resale home may not have the builder's 4.5% promotional rate, but it may be 15 minutes closer to work. It may have a finished basement, mature trees, a real backyard, and no metro district. The taxes may even be lower. The neighborhood may already have restaurants, schools, parks, trails, and service in place, not just that beautiful new Walmart that's still in the construction phase. The builder may be selling the future vision. The resale homeowner is selling the lifestyle of a completed home. That is valuable. So what do Denver sellers need to do? Study builder competition. If you are selling in Parker, Aurora, Thornton, Commerce City, Castle Rock, Brighton, Erie, Frederick, Firestone, Windsor, or any other area with active construction, your competition is not limited to resale listings inside your subdivision. Buyers are driving 5 or 10 minutes further to tour the builder models. You need to understand that those builders are what they're offering. Price with the expected concession in mind. Do not automatically price at the top of the range. Understand the likely buyer requests. Well, if I can get this house in 17 days and this home's not going to be done for 60 days, but my kids start school in, 30 days, maybe your home is there. But when they really weigh out their options and they go, okay, well, I could get a, 4.5% interest rate, like we said above. What's it to me? What's that 30 days of, hectic chaos, living somewhere for the short term to get into that for 30 years of a lower payment? Understand that the buyer may come in and say, okay, yes, we're going to need concessions, and you're priced $15,000, $30,000, $50,000 below that new build. But, usually you can see the comparables and say, okay, well, we could probably get this price for our home. But if we list here, then that buyer, that specific avatar who's going to go turn left instead of right into the new build instead of into your community, or maybe both, maybe we can kind of get them in the same ballpark for a home, get them in, eliminate the 30-day temporary housing, and go from there. So compare your price reductions versus the concessions. Pricing high and planning to negotiate later can backfire when the buyer sees a builder advertising a lower payment before they ever schedule a showing at your house. They also have to you also have to understand that if you are competing in these new build areas, your home needs to probably be as turnkey as it possibly can as an older home. So let's talk lower taxes, no metro district when applicable, finished backyard, fencing, window coverings, appliances, basement, lot, storage, established neighborhood, commute advantage, immediate occupancy, recent improvements, and known utility costs. Stop marketing only the countertops. Show the buyer what they do not need to purchase after closing. And then we're going to talk about the payment strategy. How do you compete with that monthly payment? Seller paid closing costs on a resale. That's a possibility. Permanent interest rate buydowns with those closing costs, or a temporary buydown with that concession. Price reductions, repair credits, home warranties, and a combination of all of the things depending on what you are up against. The best offer is not always the largest price cut. Sometimes a concession aimed at the buyer's rate creates more perceived affordability while protecting more of the seller's net. That needs to be modeled with the buyer's lender, not guessed from a Facebook comment section or really from a realtor. That's why I work so closely with my lenders, because I'm like, hey, this person's looking at, or in a new build community, can we kind of break down how we get to something similar that this incentive, package is offering? So what buyers need to ask before accepting a builder incentive, ask fixed rate or temporary or adjustable. What is the APR? What credit score is required? What down payment is assumed, right? Versus, does it have to be paid back as a second mortgage like CHFA and some of those? Must I use the builder's lender? In most cases with the bigger incentives, that's an absolute must, but you never know unless you ask. Is the assistance a grant or a second mortgage? Also very important. Is the second mortgage forgivable? What causes repayment? What happens if I sell or refinance in X amount, 12 months, 36 months, never, right? You have to understand those things. But if you do sell, obviously, how long's that time limit? Because a lot, especially these top ones, have some time where you have to be in the home and you have to make your payments and so on. What will the taxes be after full assessment? Not just the temporary, what it is based on the dirt. Is there a metro district? What are the HOA and community fees? What is excluded from the advertised price? What will landscaping, fencing, window coverings cost? Will the builder still be selling when I need to move? Can an outside lender improve the overall package? Sometimes it's possible. How does the complete package compare with the resale? Compare apples to apples and you'll go a lot longer. Do not compare the builder's billboard against the resale seller's MLS price. Compare two complete loan estimates and two complete ownership budgets. If you are considering buying, selling anywhere in Denver or Northern Colorado, comment your area of interest below. I will help you compare the active builder opportunities against the resale opportunities in the same exact market. For buyers, we compare the complete costs, not simply the advertised rate. For sellers, we can identify what incentives your nearby builders are offering and build a pricing and concession strategy that accounts for the competition before your home sits on the market wondering what happened. Comment your city or neighborhood or community or send me a direct message with the word compare and I will take care of it. Here's the exact position I want to leave with tonight. Builders are forcing Denver sellers to compete on monthly payment, cash to close, and total ownership cost, not just price. That does not mean new construction is always better. It does not mean resale homes are suddenly obsolete. And it does not mean every low cash and low rate promotion is automatically a great financial decision. It means the market has changed. A resale seller cannot simply look at the house next door and assume that that's the only competition. Remember those big flags that you see everywhere? That's the real competition. And that's what we're talking about. A buyer cannot look at a promotional interest rate and assume the builder is offering the lowest total cost. The builder may win on financing. The resale home may win on location, taxes, lot size, completed improvements, neighborhood stability, and future resale position. Our job is to compare the complete picture: the purchase price, the mortgage structure, the cash needed at closing, the permanent monthly payment, the property tax, the HOA and Metro District, the improvements you will need after on both resale and new builds, and ultimately the lifestyle and the eventual resale competition. Because the best house is not automatically the newest house. The best incentive is not automatically the largest incentive. And the lowest cash to close number is not automatically the safest financial decision. Before you make a move into, out of, or around Denver Metro or Northern Colorado, please reach out. Comment your area, and I will help you compare the resale builder options versus where you want to live. Let's make the decision based on the complete cost of your long-term plan, not whichever advertisement has the biggest number printed across the top. Like, comment, or subscribe. Share this with somebody comparing new build against resale homes, or a seller that's competing against new build communities and they're just feeling deflated. Let's have a conversation. I will see you next Wednesday.